Morning, ladies and gentlemen. So this is Chin Yan, the moderator for this panel discussion session. So as you can see from the slide, the topic of this panel discussion is about the power of the portfolio. So throughout this panel discussion session, we hope that our audience can have a better understanding on the effective strategy in allocating their asset across their own portfolio. And most importantly is to capitalize on the trend. So please feel free to post your question through the Slido by scanning this QR on the screen. So let's get the ball rolling by actually asking some of the investment trend that we are seeing in the investment world right now. So actually, if you may notice, there is this investment products that gaining more popularity in these recent years is on the ETF compared to some of other investment products. So actually, especially among so many types of ETF, active ETF are the one that are gaining more traction compared to the traditional ETF. So actually, we would like to ask one of our panelists, which is Jane. Are you able to share with us what is the difference of active ETF compared to the traditional ETF that we are seeing on the market at this point in time?
All right. So actually for active ETF, I think this is a very new term to many of you. So how does that different from a traditional ETF? Essentially is that it shares a common traits like a UT, where it's managed by professionals and henceforth it justifies a little higher fee, just pay a little more premium over to a traditional ETF. So this is what you commonly see in expense ratio. Other than that, it's a well blend of a traditional ETF and UT, whereby for active ETF, you can trade it freely, flexibly at any time of the day in the exchange. Unlike UT, where you can only see the final price being determined by the end of day in the NAV, right? So just imagine active ETF just like any stocks you can trade easily in the exchange. So both share some common traits as well. However, active ETF, they are more transparent. So as though you can actually look at the breakdown of each holdings and how they are being balanced from time to time. Yeah, so this basically are the main differences for ETF and UT.
So it seems like there are a lot of like advantages buying into active ETF. So I think there are a lot of investors having this question or curiosity like whether ETF can actually completely replace unit trust within their own portfolio. So Kevin, perhaps you can share with us some of your perspective regarding this question.
Well, this is not a common question. A lot of people has been asking whether ETF can completely you can include all ETF to, I mean, you can entirely dump unit trust. Well, ultimately, in terms of performance, especially when you look at developed markets, on a historical basis, no doubt, where factually most of the ETF, they manage to beat unit trust in developed market. Well, two things I want to highlight when it comes to this question. First thing, efficiency. Market efficiency, what does it mean? It means that how fast is the news and how efficient is the market to react towards the news. In some of the developed markets, let's say US, let's say EU, those markets are relatively efficient. So that is why it's going to be very tough for the fund managers, I mean unit trust fund managers, to beat the market index. So this is one of the badges that usually we receive in terms of ETF. But ultimately, does it mean that ETF can beat unit trust as a whole? Well, actually, it's not. In some of the markets that are relatively less efficient, let's say Malaysia. Let me give you a clear example. If you look at the recommended funds of our Malaysia Equities, you will be noticing that most of the funds, they manage to beat our broad-based index, FVNKLCI. Because in Malaysia, we are relatively less efficient, meaning that our news flow is not as sensitive as those in developed market. So that is one of the reasons that how the fund managers, they manage to seek alpha for investors. So a clear example, a clear cut, if you are invest in those markets that are relatively less efficient, probably active management strategy and particularly unit trust will be the viable option for you. Secondly, you can look for ETF if you want to invest in those sectors that are relatively niche. Let's say you are like what happened yesterday, CrowdStrike, Microsoft. Let's say they have raised your concern to a cybersecurity and you want to invest in cybersecurity. Currently in Malaysia, I don't think we have that much of options when it comes to these kind of niche sectors. So you're only available to find it via ETF. That is how ETF can manage to outperform in terms of unit trust when it comes to selection. So ultimately, it depends on how you're gonna position yourself in your portfolio. So yeah, overall, I think unit trust and also ETF, they both deserve a place in your portfolio.
So I think in short, right, both investment vehicle have their own pros and cons and have different positioning within investor portfolio. So it depends on your needs and what kind of exposure you want. So we know that among so many types of ETF, there are actually some unconventional kind of ETF like inverse, leverage, or synthetic. So perhaps, Alvin, can you share with us what investors should take note if they really want to include this kind of unconventional ETF within their portfolio?
Thanks. Sorry. Okay. So first of all, when you want to invest in all this type of ETF, the most important thing is to know what you are investing in. These ETFs, right, they are called unconventional ETF because they have some features, there have some factors that cause them to differentiate from a typical traditional ETF. So unconventional ETF, they can be both if you use it properly, it can be beneficial for your entire portfolio. But if you do not know what you're investing in and you just buy it mindlessly, you might find yourself a bit in a tough spot. So, for example, when it comes to leverage and inverse ETF, do you know that this type of ETF actually has a decaying effect? That means their leverage portion actually is reset on a daily basis. So it is not actually suitable for investors to hold it for a longer term. And then also for, let's say, active ETF, like just now the moderator mentioned, right? It has also some of the things that you need to know that, for example, although they have the benefit to like lower costs as well as more higher transparency for all of this active ETF, right? But in fact, right, but this ETF, they are traded on exchanges, right? So they have the bid and ask spread. So you have the risk of buying actually above the market price slightly, but when it comes to unit trust, you are buying based on NAV, so you don't have this type of bid and ask spread. And then also for like investment strategies, right? Like let's say some of the portfolio managers, when their style is like, oh, I put my money in a few stock, like let's say my portfolio is like only 10 stocks in it or 10 types of securities or in my portfolio. I want to be very concentrated to achieve alpha for my investors. But when it comes to investing in like all these active ETF, because they are openly traded, so when there are more investors investing in them, they have more assets, they have more money to deploy. They can't mainly focus on a few stocks really, so they have to broaden up to diversify more. So this will somehow they have to pay out some returns. So yeah, these are some of the points here.
Yeah, thanks, Kelvin. So looking back at our Slido, right, we actually received quite a number of questions. So perhaps a follow-up question for Alvin as well, because there is some question regarding the market outlook. So perhaps Alvin, because I know that you are also the analyst for Vietnam market, so maybe you can share with us some of the outlook for Vietnam and whether investor can gain exposure to Vietnam market through ETF, like what we discussed just now.
Yes. There are a few type of ETF that investors can consider. But first of all, when it comes to our outlook for the Vietnam market, we think we are quite positive on it because first of all, Vietnam will be the main is always the main beneficiary for the China plus one strategy. So let's say moving forward, geopolitical tensions between China as well as US increases. So more and more companies will seek to reallocate their factories and outside of China. So Southeast Asia will be one of their destination, and inside it, Vietnam will be one of the main beneficiaries as well. So as you can see, if you notice, right, Vietnam has been one of the fastest growing economy in the ASEAN region. So then we call it the ASEAN 6 because it is still small in nature, but it is growing at a very, very fast pace. So in the past, what has been dragging Vietnam down is that they don't have their northern side is mostly like a technology hub for them. But the main issue that they don't have enough electric. They have those don't have stable electric supply for the northern side. So, but now they have fully solved this issue. They have been able to transfer all of the electricity power from the southern side towards the northern side very efficiently. So this will also regain some investors' confidence towards the market, and then they will also increase their foreign direct investments to it.
Yeah, so just now Alvin mentioned about Southeast Asia, which is ASEAN. So, there are quite a number of countries within ASEAN region, including Malaysia, and we are seeing a kind of uneven growth. So there are also some audience asking about the outlook for Indonesia, which is one of the country within ASEAN region. So perhaps, Jane, can you share with us what is our views towards Indonesia market moving forward?
All right, thank you. So for Indonesia, when the first thing we talk about Indonesia, first thing that comes to your mind, perhaps the one with highest density, the one with quite a lot of commodities on natural resources in the land. So what we are seeing on how Indonesia equity market has actually evolved over the years is that we see a transformation in terms of economic drivers. So in the past, maybe just like any other Southeast Asia country, which is heavily concentrated in financials in terms of index composition. Recently, we are seeing quite a number of on the equity market. The main drivers actually come from the mining industry. So this essentially tells us that they are actually starting to gear up, and they are make good use of the natural resources that is quite abundant in the land to actually turn from being just a primary exporter to currently they are trying to add more value into it. So they want to turn up into a secondary commodity exporter by building more smelting plants, more factories in the land in order to export at a higher value. So on one hand, you get better margin, which is good for your corporates going forward. Second, you are actually more defensive because we all know that commodities actually follows a very cyclical patterns. So as what we have seen since 2023, after the commodity has its prime time in 2022, which actually serves well for the Indonesia, for Indonesia actually struggled quite somehow past year. And this year, we look that the weakness still persists because commodity prices still lagging behind. Although recently we see a pickup in aluminium and copper, however, for it to actually translate into the real cash flow for companies and more sustainable corporate profit patterns, it still takes some time. So moving forward, I believe that the fundamentals still remain rather intact, with GDP currently contributed mainly by local consumption. So export, even though it's still somehow lagging behind, we believe that the transformation within the land itself towards more industrialization, more make use of capital intensive production would bode well for the equity market. Just like how we see one fund in our platform. Initially, it is a conventional fund heavily invested in the big four banks, and currently it has been transformed into Islamic version, so that it opens more potential and more leeway for it to invest in those energy and industrial intensive sectors. Yeah.
Thanks, Jane. So we actually received some of the question regarding our recommended fund. So Kevin, just now you shared about like how we choose the fund in terms of our methodology, everything. So there's this audience still wondering why there are some winner last year not making back into the list this year. Is it they are really bad, or if they are holding this fund within their portfolio, should they actually immediately switch out? So what would be your take on this?
Okay. I would say that this is a common question where probably I really receive it every single year. Every year we are evaluating what's the performance, what's the latest investment strategy according to, all these funds that nominees for the recommended fund. Well, we came out with this latest list, and some of the funds managed to become the new winners. Absolutely. On the other hand, 14 funds, they drop out from the list. Does it mean that these 14 funds really have a bad performance last year? Some of these, maybe yes. Some of these, maybe no. So, well, when it comes to buy and sell investment advice, I always encourage investors to think for one perception. when you buy into this fund, what goal you want to achieve. Let's say if you are buying into a fund because you are optimistic towards a region, as long as the fund is still outperforming, as long as this fund is still giving you a good return, then you should continue to hold it. If you're buying a fund because you think that I buy this fund because I believe in the management strategy, I believe in the fund manager ability to seek alpha for me. Let's say if this fund they have experienced a change in terms of their investment team, it would raise a concern for you when it comes to buy and sell strategy. So ultimately, again, what I want to highlight here is it based on the moment when you enter into this fund, what goal you want to achieve. Well, I think this is quite an interesting critic question. So if you want to know more, later on you can feel free to ask to our CIS, because I think this kind of personalized advice is not it's not very optimal for me to giving a strict advice at this kind of public stage. Thank you.
Sure, thanks. Thanks, Kevin. So actually just now we've been, if you are following us closely, you'll be noticing that we are actually bullish on Japan for quite some time, like ever since last 1 to 2 years. So there is this question from audience that given our positive view on Japan, but why on our recommended fund there is only one Japan fund? So Kevin, perhaps you can follow up on this question.
Okay, so well, in our platform, we have quite numbers of recommended funds. Let's say apart from recommended funds in Japan, Aham Japan Growth, we also have Eastspring Japan, the dynamic Eastspring Japan, and also United Japan Discovery. Well, one of the reasons that we pick Aham Japan Growth as one of the recommended funds, actually the answer is pretty much clear cut. Under some of the regulatory issue, we are not able to propose wholesale fund publicly. So that is one of the reasons that when we are categorizing, when we are nominating recommended fund in our list, we excluded all the wholesale fund in our list. But fear not, when it comes to peer average, when it comes to performance evaluation, we do take consideration on all these wholesale funds data as part of our quantitative parameters for us to take a look at.
Yeah, I believe another one thing is also because the list is serving as a very comprehensive kind of guideline to investor, especially for the very new or beginner to the investing world. So we are actually trying to cover all available region or sectors. So that's why it tends to be more comprehensive. So if we're back to our topic today, which is about portfolio, right? There's one very important concept that investors need to understand before they constructing their own portfolio, which is about diversification. So I believe most of you should have heard about do not put all your egg in one basket. But I think rarely have people tell you or teach you how many baskets you should have or how many eggs you should have in each basket. So this is a very important concept because sometimes you might think that you already achieve diversification, but in fact you might not. So before I pose a question to our panelists, I would also like to invite our audience to actually interact with us through the Slido. Same QR code. We actually put out some question for you to answer. So how many holdings that currently you have in your investment portfolio? So meanwhile, Kevin, perhaps you also can share with us how do you think we can practice the diversification?
Okay, well, how do I practice diversification? Pretty simple answer. Nasi kandar. Well, actually, it's more or less similar strategy where don't put all the eggs inside a basket or portfolio inside a basket. It's a very theory kind of stuff. Does it really realistic? I will give you my personal example as my experience. Well, I like to time the market. I think that because semiconductor, let's say currently the valuation is expensive, then I feel like, oh, probably we're gonna experience a pivot soon. So I short semiconductor. Then I think I look for some cheap stuff. Let's say that time at some point of time, I think Japan is quite pretty cheap. I mean, probably is a good time for me to buy Japan. But ultimately, throughout the past few years, I think I started my investment journey about 2016. Many years ago, maybe sometimes you can gain profit from there. Sometimes you will gain losses from that. Why? Because no one have the ability to time the market accurately. Well, one stuff that I learned, and I think that is one of my precious previous experiences will be don't time the market, time in the market. I know it's a little bit like textbook stuff, but ultimately, when you invest in something, you need to ensure two stuff. One thing, that invest in those things that you can control. And secondly, ignore those things that you can't control. Let me give you an example. If I believe that AI is going to change our work, what should I invest in? AI-related sectors, stocks. So this will be what I can choose to invest in. That's why I invest in those companies that have a strong economic mode, solid balance sheet, cash flow. So the moment when I put money inside, I ask myself, is the statement still valid? Maybe after many years later, we are seeing a new geopolitical tension, a new virus again, those things that we couldn't manage to control. So let's say if this thing happened, I ask myself again, is the statement that time when I enter this investment, is it still valid? If it is still valid, if the AI trend is still ongoing, then you should continue to put more money inside. In fact, average down. On the other hand, what are those things that you couldn't control? Let's say rate cut. I know a lot of people, some of the common questions that the market is always asking is, will the Fed reduce the rate in September? Well, to be honest, no one in this market, no matter it's from us, no matter it's from Wall Street experts, no one accurately they know what is going to happen in September. So that is one of the things that you couldn't predict. So since you couldn't predict, why you need to make this kind of statement to impact your investment journey? So let's say if I'm holding AI, if I'm holding large cap stocks, and I'm expecting, let's say if the Fed they really make a rate cut, then it could be a catalyst for these stocks. Then I'm happy to hold it. What if the Fed they don't cut rate in September? Then the market is going to be jittery. Might cause a minor drawdown in terms of market. So at that point of time, I need to ask myself again, is my statement still valid? So yeah, as long as I'm still believing AI trend is disruptive, those companies are still solid, then I should continue to hold it. So yeah, I think overall, diversification means that you need to diverse your portfolio, separate it into nasi ganda, core, tactical, get some stabilizer for your portfolio, and also get some performance driver for your portfolio. I think that's pretty much enough of my presentation. Thank you.
Yeah, thanks, Kevin. Hope everyone has a better understanding through this very lively example provided by Kevin. So back to this question, we actually saw some quite interesting result from our audience. So perhaps Jane, can you help us to interpret the result that we are getting from our audience? Like I think majority of them are having less than 10 holding within their current investment portfolio.
So obviously, I believe that many of you chose 11 to 20 at first, but eventually, I think the less than 10 crowd actually take over. Well, in terms of diversification, it actually rests on 4 key pillars. First, you have to better understanding of what you are buying into. Having a good financial knowledge, understanding each asset classes, each products in terms of whether it's stock, ETF, unit trust, commodities, or even REITs is very important. So that you can actually spend your time to closely monitor the changes, to make timely adjustment as well when you believe that there is a fundamental change that you have to rethink about your investment decision. Secondly, I believe that having too much, if for those who have more than 20 holdings in your portfolio currently, you may be a little bit overwhelming because you have to tend to spend more time. And on the other hand, there could be quite a number of holdings that is overlapping, means they are actually trying to capture the similar return that you're expecting. So I believe that each holding that you have should provide you the unique edge, and they should have their strength to capture some of the potential return that you think only this class of product is able to provide you. And one thing is that investment is a long journey. So having too much may be just like you are making a dish. So you're putting too much ingredients into it, and perhaps the taste doesn't is what you're expecting. So sometimes just make use of few key ingredients and just make just be very good at making few good dishes. It can be actually quite enough already. So for a long-term journey, make sure you pick the correct one, the high quality one, which actually serves to last to have a more lasting position in your investment portfolio. So on the other hand, it's actually come down to risk adjusted return. So for different asset classes, they have their on return capture ability as well as the downside volatility. So for instance, like REITs, they are very sensitive to interest rate changes. So if you invest in them, while at one time you get the dividends, but on the other hand, you have to closely monitor the impact that interest rate changes could have on the REIT itself. Similar to some other commodities or some equities and bond fund, some of the unique characteristic that inhibits. Yeah.
Yeah, thanks, Jane. I think there are a lot of information coming from Kevin and also Jane. Perhaps we can listen to Alvin on some actual real life example, like how is your portfolio practicing diversification given your risk profile, your views towards market, everything?
So I actually practice diversification, but one thing I want to like to bring out is diversification can be beneficiary, but at the same time, over diversification can be a risk. Why is that? Because to elaborate just now what Jane mentioned, so every security or every asset class or even geographical regions, right? They have this kind that we call it correlation. That means sometimes a low correlation means that when a stock up or a equity up or a security up, the other one either I don't up, either I up a little, or either I drop. So this causes a low correlation. So this helps you this is the main core part of the purpose of diversification. But if I have too much things in my portfolio, first of it, it's very hard to control, to monitor. But second of it, so because of all of this security, they each gains are offset by a loss from another. So you will have in the end, you will have this, your returns are capped. So for me, I'm an aggressive investor, so I normally keep my portfolio below around 10, but which I can closely monitoring, and which I will every day read news about it, every day study, every day monitor any developments on the investment I have. So so most importantly is to always invest in things that you know. Yeah, that's the main core thing.
Yeah, thanks, Kevin. Thanks, Alvin. Sorry. So, back to the question we have on Slido, right? We actually have a question regarding Malaysian equities because we know as a how we actually quite bullish on Malaysian equities. So, Kevin, there is this audience would like to understand, like, if they want to invest in Malaysia equities, what are the sectors that they can focus on, especially with the recent trend, like data center, tech company increase their investment. So, what is your view on this?
Finally, one market question for me. Okay, well, for Malaysian equities, I will conclude it using 4 words. Back to the past glory. Many years ago, Malaysia was one of the 4 Asian tigers. We are very famous in terms of industrialization, in terms of exports, in terms of community display. But coming to, what we have experienced in the past few years, we have experienced what? Political instability, macro backdrop. So all these uncertainties that are causing Malaysia to have a sluggish performance back then. But coming into the year of 2024, there are the few reasons that giving us the supporting view towards Malaysian equities. Well, there are 3 regions instead of sectors that I want to highlight here. There are 3 regions that you should focus on if you want to invest in Malaysian equities. First one, Kuala Lumpur and Johor. Why? Because of data centers. Well, data center is not a new stuff, to be honest. Back then in Singapore, I think they have been developing data center, this kind of technology for many years. And what makes investors so hyped about data center is because of AI development. So in ASEAN, like what my colleagues just now they mentioned, because of geopolitical tension, investors, they are looking for an alternative to place their data center in. When Malaysia, because our electricity bill relatively cheap, we have abundance of natural resources. Our land, our water is also quite cheap. Next, in terms of this all these disaster, because Malaysia geographically wise, we are quite fortunate. We are quite lucky because we we don't experience all these disastrous events. So this is one of the reasons that foreign investors, they like to invest in Malaysia. So what causing them not to invest in Malaysia back then is because of this macro backdrop. But coming into the year of 2024, where we starting to observe more stability, more certainties. I mean, the certainty is not just because of the macro trend, it's also because of our political stability. Well, we anticipate that in the next couple of years, probably this government is hopefully is going to continue to be stable. And this kind of stability, it injects some confidence for foreign investors. So it could drive Malaysia to a higher stage. So that is one. Data center, where Johor and also Cyberjaya will be one of the key areas that you should focus on. Secondly, Penang. Why? Technology hub. Well, because of a semiconductor upcycle, it's not just about AI, it's also about the advancement of technology. Let's take a quick view of what happened to all these US giants like TSMC, ASML. Even in next week, some of the digital economy, they're going to launch their quarter report. We are expecting that all these companies, they're going to deliver a pretty solid result. So it's just a matter of guidance. Despite the guidance might be slightly underperforming what the market is expecting, because the market is overhyped towards the guidance. But ultimately, we still think that overall, it's gonna be a positive outcome from all these companies. So from this trend, we can observe that technology is a circular trend. And Malaysia, compared against our ASEAN peers, Vietnam, Singapore, Indonesia, Thailand, what we have a relatively mature ecosystem in Penang. Well, personally, I'm come from Penang as well. I stay in Penang when I was young, and I came to KL, I think like 7 years ago. So back then in Penang, I do experience that some of the regions there, Batu Kawan, Bayan Lepas, they are relatively rural. And a few months ago, I just go back to Penang. I went back to Penang, and I realized that Penang has already become, they already transformed into a relatively advanced state. So that is how Penang benefits from the technology circular trend. So this is the second one, Penang, technology. Third one is Malaysia. First and foremost, abundant natural resources. East Malaysia, they're always well known with this kind of, they have pretty much of resources. But what are the main detractors of causing East Malaysia related equities to be relatively sluggish? Is because of a political instability. But coming next, we all know what happened in the Malaysia political landscape. And I don't think that the government, they are able to secure the majority with just only one party. Meaning that East Malaysia is going to be one of the key partners they are looking for if they want to secure a majority. So that is how in terms of political decision, they need to inject more flows into East Malaysia. They need to refocus on East Malaysia. Secondly, Indonesia, they are going to relocate their capital from Jakarta to Nusantara. So just a quick geography introduction. Nusantara is just located below East Malaysia. Well, below the Borneo Island. So with this kind of relocation, you're gonna need a lot of constructions, you need a lot of industrials, you need a lot of basic materials in order to support the entire infrastructure. That is how East Malaysia related equities able to secure from them. Well, I think it's pretty long answer. Let me just quickly summarize. First and foremost, data centers, Johor, Cyberjaya. Secondly, technology. Why? Because of China plus one, because of a geopolitical tension, because of the infrastructure. Thirdly, East Malaysia is going to be a new economic powerhouse. Why? Because of utilities, because of relocation of Nusantara, and because of infrastructure. Thank you.
Yeah, thanks, Kevin. Indeed, it was a very thorough analysis and explanation by Kevin. If I sum up his answer using one sentence is, you must have Malaysian equities within your portfolio. So due to time constraint, we will stop our panel discussion here. And all in all, I think the message we want to deliver today is portfolio investing approach is very important to help you achieve your financial goal, as well as to achieve a very good diversification. So thank you, audience, for your time. So also thank you, our panelists today.